Well, I think, unfortunately for China, they're in a little bit of a dilemma now with the fact that they're trying to target multiple financial prices, whether it's property prices, equity prices, the exchange rate, and now, of course, bond yield. So I think in the short term, the balancing act will probably be through the exchange rate. The interest rate differentials now between China and the US continue to widen. So it's more than likely that the exchange rate's going to depreciate over the next 3 to 6 months as the markets become accustomed to the fact that the Fed is probably not going to cut more than 25 basis points this year. So the exchange rate is really the sort of litmus test for the Chinese financial markets.
Yeah, we've gone well past 7:30 on dollar China. In fact, H is on your screen right now. We're at 36.19 or so. I mean, most folks we talk to think the next stop fairly easily is going to be about 7.5. What say you?
I think that's not too unreasonable. Ironically, a weaker exchange rate would solve quite a few problems for the mainland authorities. One is that it would be an easing in financial conditions, which we have real rates still very high in China. Secondly, it would allow some inflation to be introduced into the economy vis-a-vis imports and also from by better competitiveness. And last but not least, I think it's going to allow the exchange rate to play catch up with its trading partners, or its peers. If you look at where the yen has traded over the last 4 to 5 months, the authorities in China have lost relative trade competitiveness. So all in all, a weaker exchange rate would do a lot of good for the economy from where it's sitting at the moment, and would probably be beneficial for equities.
So, Sean, on that front, right? So a weaker Chinese currency would help import inflation. I get that. We've been talking about how the US and UK are teaming up and trying to slap these new sanctions on Russia on its oil exports, right? So key buyers, as we all know, Russian oil, China as well as India. If that's the case, it means that they're going to have to, in this case, China specifically, they're going to have to source their oil because they can't meet all of their own needs from elsewhere, which is likely to mean higher prices. And in a strange way, potentially that could also be beneficial to China, which is struggling with a deflationary environment, no?
I would say that's partly correct thinking. I think we have to recognize that OPEC itself has found it very difficult to constrain supply, and of course China's relative growth rate compared to where it was in terms of oil demand in the past decade has decelerated quite considerably. So yeah, and to some extent that's true. I think the second thing to bear in mind is that, of course, the dollar is near all-time highs in nominal exchange rate terms. You're importing oil at a very high cost, which, yes, it introduces some inflation, but given that China's got a very relatively high energy consumption ratio, that would actually start to hurt a lot of the margins for Chinese companies. I think the way to think about oil is that perhaps the biggest variable that might mishap bond markets, including in China, from here may be higher food prices. If you look at daily necessities, whether it's coffee or sugar, all of these have been moving up over the last 3 to 6 months, and certainly perhaps a higher oil price accompanied by much higher an acceleration in food prices would be fairly disastrous for global bond markets, and to some extent would help reverse some of the problems that we see in China at the moment. So I think food prices may turn out to be the biggest variable in adjusting for inflation rates globally from here, perhaps less so for oil prices.